Awesome. So you guys saw the initial setup for the long straddle, which is super great. Now I want to look at a little bit of a reversal on it and then talk a little more about the order entry and exit point for straddles. And so that, of course, would be the short straddle. So this is kind of the opposite, obviously, of the long straddle. And it's interesting. It kind of looks like a butterfly setup, which we'll get to soon. But what's cool with it is instead of actually buying a call and a put, you sell a call and a put kind of around the exact same price point. So this would be more if you just think a stock is kind of going to stay in the same trading range and not move very much, which is what a lot of these more complex option setups are kind of based around, which is pretty freaking cool, especially if you have maybe a stock that you don't think is going to go up or down too much, maybe like an index or an ETF or something like that, but you don't know really if it's going to be up or if it's going to be down, or maybe you think that it's going to stay the same trading range up and down, and it's just going to go sideways. So, it literally just doesn't do anything at all. And obviously, the way you set this up, if you have them at the same point right here, it's going to be based around the middle. And another way you could do this is to sort of spread it out, kind of like we spread out our initial straddle, right? So remember with our original straddle setup, it was a little bit more spread out. So you would sell the call and sell the put, and then you're giving somebody the ability to buy it from you. If it actually goes down a whole bunch, you're going to be forced to buy at a higher price. And then same thing here, you're going to be forced to sell at a lower price if the stock goes up a whole bunch. And so that would be selling your call here and selling your put here versus selling them at the very center at the same point. And you can use sort of this same center strategy over on like your long straddle. So if you have a stock set up, remember with the long straddle spread out, but you could definitely do the same thing we're doing here and sell that straddle at the same price point, and then you're going to kind of narrow that trading range. So this is just this would be a little bit lower, right? It's just going to increase your cost depending on the options, right? So the options closer to the money are going to cost more versus buying, a call here and a put here where it's out of the money, right? So this call or a call here, and a put here. So this put, since the price is below the current price, it would cost a lot less because it's out of the money. This call is out of the money, so it would cost a lot less. Versus buying them right in the middle, that's going to cost more, right? And so that's why you usually would spread it out for a long straddle. But with a short straddle, it makes sense to go right here in the middle because remember, you're getting paid to write the options. So you're going to get paid more when you sell in the money calls and in the money puts based closer towards that spot price most of the time. So just look at it on a stock by stock basis and figure out if it makes more sense to spread out your call and your put, or if you want to keep them in the same spot. Again, you would we just went over the straddle, so you're just buying your call and buying your put right here, and there you go. That's the strat. And again, here you're selling a call and you're selling a put. So cool stuff. And that would be how you would sort of set up that indicator. And again, guys, if you need to reference any of this, it is all in chapter 21. So that should give you sort of the details, the fine grains. But the overarching application for a short straddle, again, really is if you just think it's going to go sideways and tinker off. It's a nice way to make a small profit. For most of the trades I've made using the short straddle, and then it's the same thing with selling calls. You might make about 2%, which I think is pretty good. You can make like maybe 2% a month per position on a pretty decent volatile, but not too crazy stock. With this strategy, that 2%, it's a pretty reliable 2%, and especially if you know what you're doing, you can do really well. I prefer using just like covered calls and just selling calls because you're only going to make money if the stock goes up. You're gonna just sell it at a higher price, which I think works really well. But with this one, you sell them both, so you're kind of like doubling that income that you make from the positions that you have. If this is a covered straddle, or obviously if it's an uncovered straddle, you're just speculating here and making a ton of bank. by selling options, which works really, really well. And you just write them out. And again, your upside is if the stock doesn't move, but your downside here is a little bit risky because this kind of has like an unlimited downside. Whereas the straddle has an unlimited upside, this one, the short straddle, has an unlimited downside, and that's a little sketch. So that's why you really do need to be careful with these because when you're selling options, you can get yourself into situations where you have a very limited upside and a massive downside, and that's why I'll usually stick with just selling those calls that are covered so that I know if I get out of this trade, I'm going to take my profits and my initial gains on the premium. And most of the time, you're not going to actually get forced to execute the option, and you'll just keep that premium, which works out really, really well. And this is great too. It just depends on that spread. So because you can just double the premium that you receive. So it's a stock by stock basis. But if you have a stock that really, really, really is just going sideways, and you think it's going to keep doing that over and over and over and over and over and over again, and you can be, pretty liberal with where you sell these options. I mean, you can sell them pretty far outside of the trading range. If you're pretty confident in that, then this is a really, really good way to monetize that asset. And it works actually really well with like REITs. You guys know real estate investment trust, REIT, or any other kind of high dividend paying stock that pays like 4, 5, 6%. And usually you'll see those stocks, they just trend sideways and then they pay like 5% dividends. So if you're in one of those positions, especially for your long-term portfolio, this is a really, really good way to use options to generate income from those because they don't vary a lot, especially in normal market conditions. They just kind of go sideways and people expect to receive their dividends, and that's all they expect from the stock. So a really good way to increase your profit and really your income from those high dividend playing stocks like the REITs, mines, stuff like that, where they just go sideways, is to use this short straddle. And it works really, really, really well. And you can increase that 6% return to maybe 8%, 10%, 12% over the year just by using this one simple little trick that, doubles your return. So awesome stuff, guys. That kind of sounded like the title of like some crazy investing magazine because honestly, like it is. So definitely give it a shot, especially if you have some of these more stable long-term positions in your portfolio. This is a great way to use options for those longer-term investments that are very, very, very stable. One of the few circumstances where it makes sense to do so besides iron condor, which we'll look at in just a moment. So really cool way to use short straddle, and it's also pretty simple, right? I mean, you sell a put, you sell a call, and that's it. So yeah, really cool stuff, guys. Again, more info in the chapter on it. I haven't been messing with these in a while just because I've been doing pretty active trading lately and just been crushing it at that. So I haven't had a need to get 10% returns when I'm making 10% a trade. So rushing up on this, and it's freaking cool, especially if you don't want to put the time in for active management, but you do have maybe an hour or two a month at the end of the month where you can just spend a little bit of time increasing the performance of your overall portfolio, which is sick. I mean, you guys are putting in the time to learn about the education and understand these concepts now, and it's just going to pay you dividends year after year after year after year in the future because really all it takes is to just sit down and have a dedicated focus on your assets for just a couple of hours a month, and you can seriously outperform a vast majority of professional Wall Street hedge fund managers that are just like having a blast. Those guys are living the dream, but a lot of times it's not necessarily the best way for you to have the most returns possible. So this is one strategy that is very, very, very rarely talked about, but it's a great, great way to increase your returns from those very, very stable dividend-paying stocks. And if you do this over the course of 10 years, I mean, I want you guys to understand, like, think about the compounding effect that would have. You could make 4% more per year for the next however long until you want to retire, you want to have a big party, you want to have a big savings goal, whatever you want. Like, think about the impact that would have. Go to like a compound interest calculator. That's why I'm talking about compounding, right? That's a pretty freaking big percent change. I mean, that's a big impact on your portfolio growth, and it's all just using this one simple leverage tool for options to actually write these and distribute them into the marketplace to provide additional value. Again, You want to make sure that you understand the fundamentals and you understand technical analysis when you do this, which is why I'm teaching it to you, and that'll help you minimize the risk and make sure that you know that this stock is doing nothing. But I mean, I'll be honest, if a stock has just gone sideways for the past freaking 4, 5, 6, 7, 8, 10 years, you're probably gonna be cool if you sell like a 1 month option, because you can always buy them back if like the world freaking ends. But even in '08, I mean, the biggest crash, the biggest recession in a long time. I mean, if you look at most of the major crashes, I mean, they happen over a course of months or years, right? So if you just keep selling 1 month options over and over and over and over, you've got a pretty small risk. And obviously, you increase the time period, you're going to increase the amount of money that you can make, but you're also going to increase your exposure risk over time, right? So what I would do is I would look, and say, well, how much money would I generate if I sold 12 1 month options versus maybe, I don't know, 48 1 week options versus 2 6 month options, and look at the particular stock, the particular market conditions, and especially the volatility at the time, and figure out if it makes more sense to sell them every single month, every single week. But it's pretty freaking easy to manage if you just sell them every month and you collect them check in the mail, and you do it over and over again, rinse and repeat, and you can pay those dividends, especially from like REITs or like high yield bond funds. These are really, really good candidates for short straddles, because bond funds specifically, they try to keep them as stable as they can. And I talk more about it in chapter 22, which is it's just really, really, really cool, especially if you're nearing like that retirement age or that savings goal. Yeah, chapter 22, a lot of freaking gold in there about bond investments and bonds versus bonds. I mean, just so much that you can leverage with this tool. So make sure that when you're reading that chapter, you apply this and you think, how can I multiply my returns by selling options? And then look at the value of those options and say, well, I guess I can multiply it by 5%. Whatever the percent is, like, understand that this is basically free money to the extent that you get it right. You have to get it right. And so there is an inherent risk to this, right? And so that's why we're looking at the time frame, we're looking at the technicals, and we're looking at the price where you sell at, so that you minimize that risk to be as small as possible. Sound good? That makes sense? If this is covered, the call shouldn't lose you any money. It's mostly the put that you should be worried about if you have to buy it at a bad price. But again, if you're averaging out your cost over a couple of years, not a freaking big deal. If you're a long-term investor and you have to sell at a super high price and then you're averaging it out over the next couple of years, not a big deal. So this is a really, 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 really good way to keep averaging into a position if you're going to keep buying stock or a fund over and over and over, specifically a fund, since that's better for diversification and portfolio correlation like we talked about in chapter 35. This is a really solid way to just increase that income, and then if you ever have to buy in, then you just buy in because you're going to buy in anyway. So definitely a cool way to get paid to invest the way that you would have anyway, using the power of the short straddle. So awesome stuff, guys. Hope you got a ton of value from this. And again, these are a little bit, technical. You have to kind of know where to sell the calls and sell the puts and what to do, where to do it. And that's why I go into a lot more detail, just like word by word in the book. So please, if you are going to make big investments based on this, just review the text and make sure you know what you're doing before you go in it. So awesome stuff, guys. Thank you so much. I really appreciate it. And thanks so much for watching this module. So I will see you in the next one, and we'll look at the next setup. Thanks, guys. See you there.